Hey everyone, and welcome back to my channel. If you're new here, I'm really glad you're tuning in. Today's topic is something that every investor, trader, or even someone just curious about global economics needs to understand, and that is how tariffs and trade wars impact the stock market and what history has shown us. Now, when we talk about the stock market, most people focus on things like company earnings, interest rates, or inflation. But trade policies, especially tariffs and trade wars, have historically played a huge role in moving markets, sometimes causing major volatility and long term trends. So, in this video, we are going to break this down in a way that's simple, real, and directly tied to market reactions. We will walk through some key historical moments, starting all the way back in the 1930s, and then we'll touch on modern day examples like the U.S. China trade war, and finally understand how we as traders or investors can react smartly to such situation. All right, let's get started. So, what are tariffs and trade wars? Let's begin with the basics. A tariff is a tax imposed by one country on goods and services imported from another. The idea is to make foreign products more expensive so domestic industries can compete better. Sounds logical, right? But here is where things get tricky. When one country imposes tariffs, the other country usually retaliates. This back and forth escalation is what we call a trade war. While it seems like governments are just trying to protect local businesses, these moves can lead to massive ripple effects, hitting exporters, supply chains, companies' profit margins, and ultimately investor sentiments. So, how does all of this affect the stock market? To understand that, let's go back in time. The Smoot-Hawley Tariff Act of 1930. This was passed in the US during the Great Depression with the intention of protecting American farmers and manufacturers by raising tariffs on over 20,000 important goods. But what happened instead? Other countries held back with their own tariffs. Global trade plummeted by over 60%, world economies slowed down even further, and the depression deepened. The stock market reacted brutally. Between 1930 and 1932, the Dow Jones Industrial Average fell by nearly 85% from its 1929 highs. While the crash had nearly begun before the tariffs, the trade war policies extended and worsened the economic downturn. Lesson learned. Tariffs might seem protective in the short term but can be disastrous when they spark retaliation and choke off global trade. Alright, let's fast forward to the 1980s. President Ronald Reagan's administration was dealing with massive trade deficits, especially with Japan. The US imposed tariffs and pushed Japan to limit exports of cars and electronics. While the impact wasn't as devastating as the 1930s, it still caused uncertainty in the markets. Investors grew concerned about rising protectionism, and there were short-term sell-offs. But what's interesting is Japan responded by investing heavily in the US assets instead of retaliating with full-scale tariffs. So while tensions existed, both nations found middle ground and markets stabilized. Still, it was a clear signal. Trade tensions, and even without a full-blown war, can lead to volatility. Alright, now let's move to the most recent and high-impact case, the U.S. China trade war under President Donald Trump's first reign. In 2018, the Trump administration launched a series of aggressive tariffs aimed at reducing the U.S. trade deficit with China and protecting American manufacturing. Tariffs were placed on over $360 billion worth of Chinese goods, ranging from electronics to steel, aluminum, and consumer products. In response, China imposed retaliatory tariffs on $110 billion worth of US exports, including agricultural products like soybeans, meat, and energy. This back and forth triggered a full-blown trade war that shook the global markets. Here is what happened in the stock market. May 2019, When trade talks between the US and China suddenly collapsed, the S&P fell over 6% in just a few days. August 2019, markets plunged again after Trump tweeted about increasing tariffs and China retaliated. The Dow Jones dropped over 600 points in a single day. Tech stocks like Apple, Nvidia, and Qualcomm took major hits due to their supply chain exposure to China. At the same time, safe haven assets like gold, US treasuries, and the Japanese yen rallied as investors sought safety amid the uncertainty. The constant policy changes, tariff hikes, and tweet-based diplomacy led to extreme market volatility. Traders had to not just their strategies but their timelines and risk management. In fact, during this period, it became common to see 300 to 500 point intraday swings in the Dow Jones based purely on headlines. But here is what even more interesting happened. While volatility was high, the market did not crash. In fact, in late 2019 and early 2020, we saw rallies because investors began pricing in a potential resolution. A temporary truce came in the form of the Phase 1 trade deal in January 2020. Markets responded positively, and many sectors, especially tech, saw sharp recoveries. This era showed us that markets can absorb a lot as long as there is a hope of progress and communication, but the uncertainty, that's what hurts. Now let's focus on the most recent developments as of April 2025. On April 2nd, 2025, President Donald Trump announced sweeping new tariffs on imports from multiple countries, branding the day as one of the American industry rebirth, or what he termed Liberation Day. These new tariffs included a 10% blanket tariff on all imported goods, 25% tariffs, especially on auto imports and parts, and even harsher tariffs as high as 50% on select developing countries, including Lesotho and others. The stated goal was to reduce dependency on foreign imports and bring manufacturing back in the US. But the stock market did not take this news well. On April 3rd, the Dow Jones dropped over 1,600 points, its sharpest single-day fall in years. The S&P and Nasdaq followed Dow Jones, with sectors like automobiles, electronics, and retail being hit the hardest. Investors immediately feared two things: a global retaliation, especially from major trading partners like the European Union and China, a potential rise in inflation as imported goods become more expensive, pushing up costs for businesses and consumers alike. But that was just the beginning. Now let's analyze how the trade war will affect us in coming months of May to August 2025. As the trade war will deepen in the months following the April tariffs, we will see a chain of reactions of events across the global economy and stock markets. Here is how things will unfold. By May 2025, retaliation will begin. By mid-May, China, EU, and even Canada will impose counter tariffs on American exports, including soybeans, semiconductors, and aircraft parts. This will hit companies like Boeing, Intel, and major agriculture firms. Markets will remain volatile, with daily swings of 300 to 500 points on the Dow becoming the new normal. Consumer sentiments will also begin to dip, as prices of imported goods, from smartphones to clothing, will start to rise. By June 2025, earnings shock will come. As Q2 corporate earnings will be released in June, many companies will issue profit warnings. Giants like Ford, Walmart, and Apple will report squeezed margins due to increased import cost and disrupted supply chains. This will lead to a broader market correction, with the S&P 500 slipping nearly 8% over the month and the tech stocks falling over 12%. Investors will begin to rotate their portfolios into safer assets. Golds, bonds, and defensive sectors like utilities and healthcare will see inflows. By July 2025, inflation and interest rate fears will rise. As tariffs will push up cost across industries, inflation will begin to rise sharply. The consumer price index for June will show a year over year increase of 5.8%, its highest in almost a decade. This will raise fears that the Federal Reserve might be forced to hike interest rates despite a slowing economy. Bond yields will surge, and growth stocks, especially in tech, will be hit hard once again. This will create a stagflation scares, a dangerous mix of rising prices and slowing growth. By August 2025, layoffs and recession fears will gain momentum. While supply chains disrupted, cost increasing, and export markets shrinking due to retaliation, many companies will begin to take cost cutting measures. Several large manufacturers, including General Motors and Caterpillar, will announce massive layoffs. Unemployment will be ticked up slightly, and the GDP growth forecast for Q3 will be revised downward by multiple banks. This will lead us to more panic selling, and by late August, the major US indices will be down by 15 to 18% from their 2025 highs. Some experts will be giving warnings that if a US market resolution would not be found soon, the US could head towards a recession by year end. This all will happen if corrective measures are not taken right away. Now let's analyze which sectors will be most affected if all this goes in the worst possible way. Alright, so now let's talk a little about who gets hit hardest during these trade wars. Export heavy industries like manufacturing, semiconductors, and agriculture are usually among the first to feel the pain. Multinational corporations that depend on international supply chains, think Apple, Tesla, Boeing, often see margin pressures, delays, and demand drops. Retailers who import goods from overseas will face rising costs which can be passed on to consumers or absorbed in profits. Either way, it's a hit. On the other hand, some domestic focused companies and defensive sectors like utilities or healthcare tend to be more insulated. And ironically, during heightened uncertainty, gold bonds and safe haven currencies like the yen tend to rally. So the next time there is a news about tariffs or trade tensions, zoom out and ask which sectors will benefit or get hurt. That can help you build smarter trades. Alright, so how traders and investors can navigate this environment. So what does all this mean for you? Whether you are a short-term trader or a long-term investor or just someone trying to protect your capital, here are few takeaways. Expect more volatility. Trade wars create an environment of constant uncertainty. Headlines can move the markets intraday, so be cautious with leverage trades and tight stop losses. Focus on domestic driven sectors. Industries less reliant on imports or exports like utilities, telecom, and domestic banking tend to perform better in trade war environments. Watch inflation hedges. Commodities like gold, silver, and even oil often become attractive during global tensions and inflationary periods. Diversify internationally. If US or Indian stock markets are under pressure due to policy moves, look at international markets that are less exposed to these tensions. And don't panic and stay informed. Trade wars eventually lead to negotiations. Smart investors stay informed, keep cash ready for opportunities, and avoid emotional decisions. Tariffs and trade wars are not just political tools, they are economic weapons with real measurable impacts on companies, industries, and stock markets. From the Smoot-Hawley disaster of the 1930s to Trump tariffs in the 2020s, the lesson remains the same. Markets don't like uncertainty, and policy-induced disruption to trade flows can create short-term panic and long-term shifts. As a trader or investor, your job is to stay informed, stay disciplined, and adapt. Understand how policies shape sentiment. and follow the capital flow and never bet blindly. If you found this video helpful, make sure to hit that like button, subscribe for more market insights, and leave a comment below with your thoughts or questions. I would love to hear what you think. Until next time, stay calm, stay sharp, and keep learning because markets always give you another opportunity.